Welcome to GRE. I'm your host, Keith Weinhold. How do you vet a property manager and maintain an ongoing relationship with them over time? I just hired one, and I'll tell you how I did it. Then there's a trend to exploit in today's real estate market with the opportunity to place zero money down on brand new build property today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. Yeah, this is Get Rich Education, the voice of real estate investing for more than 10 years now. This is episode 523, and I'm your host, Keith Weinhold. Let's talk about how to vet a property manager. After all, they are what make your real estate investment mostly passive. I recently hired a new property manager. Of course, I have one in each geographic area where I own property. Now, instead, you can self-manage from a distance, but sooner or later, you probably won't feel that's the highest and best use of your time. As friend of GRE and host of the Real Estate Guys radio show, Robert Helms says, life is too short for property management. And you know, when it comes to managing your property, still today, you can't just have an AI do that. And to me, your property manager is the most important piece of your team because they're the ones that handle all the tenant relations, collect your rent, and they control your occupancy rate too. I think you can make the case that a property manager is even more important in larger apartment buildings than they are in, say, single-family rentals up to fourplexes, and that's for a few reasons. Number one, because managers drive your net operating income, your NOI in apartments, okay? So that doesn't just drive your income, that drives the very valuation of the property, since apartments are the NOI divided by the cap rate. And secondly, one bad or noisy tenant can make other apartment tenants miserable. Yet if there's one noisy single-family home tenant, well, others might not even know about it or hear them. So a manager is more important in large apartments than smaller units, but let's not let the point be missed. They are crucial, just vital either way. And when it comes to qualifying a property manager, you know, before you reach out to that manager, do some research on your own first. First, I like to see if I have any friends that use that management company, and I like to get feedback from them. I also like to read reviews and see what current investors that use that property manager say about them in forums. And, you know, from real world experience, if you've been an investor for any period of time, it's a little sad to say, but getting reviews that are merely adequate or average, that might be good enough. There aren't many places in life where I accept mediocrity, although property management is probably one of them because it's just a tough job where that manager has to adjudicate, use their judgment, and walk a line between two antagonistic parties, and those parties are you and your tenant. So adequate is good enough. Management is just one of those industries. It's kind of like airlines always seem to get bad reviews too. If there's a rating system out there for umpires and referees, it would probably be the same. Users only comment when there's a problem. Well, when vetting a property manager, next, I like to know how long they've been in business. I also like to know how many properties that manager currently manages, how many units they have in their management portfolio. And with this latest manager that I just recently hired, it happened to be 325 properties. That's a good number. And this manager also happens to be one in a network of a nationwide management franchise. So there are some systems and some economies of scale that I'm getting. And there are a lot of mom and pop managers too, and they can often do a good job as well of scaling and automation. A lot of managers, for example, they leverage a software like Appfolio, where you, as an investor, you can log in and see your investor activity and your owner draws there. So this particular new manager that I hired, they have those 325 properties that they manage. But speaking to geography, I learned that their brick and mortar presence, their main office, it's a full 45 minutes away from where I have my properties all clustered. Well, it's not ideal to have my properties far flung from their hub because you want your properties to get adequate attention. And you can imagine if your properties are too far from where most of their operations are, well, then your properties might not get enough attention. But I learned that they already have 20 properties in the immediate area of mine, and that their maintenance man also happens to live near my property. So in this case, 45 minutes from the satellite office, although it's not ideal, it did work for me. This new manager that I hired has the tenant's rent be due on the 1st of the month, but they have a grace period to pay until the 5th, and then the owner draws, they're made around the 10th of the month, and the owner draw, that means when the manager makes their payment to me, the investor, which is after they collected all the rents minus their management fees and maintenance expenses. All right, well, all that stuff is pretty typical. And let me tell you now about their management fee structure. And again, this is pretty typical. And by the way, I don't try to negotiate fees with managers in most cases, maybe unless I have an awful lot of properties with them. They have a monthly management fee of 8%, now 10%, that's a pretty common fee out there as well, meaning that if rent is $2,000, they take $160 each month in a management fee. That's that 8%. And then additionally, their leasing fee is 1/2 month, meaning that when they screen and place a new tenant for me, they get $1,000 at that time, again, on this example of a $2,000 rent, and I pay a $150 re-leasing fee, meaning if they re-lease the unit to that same tenant after, say, their first year or two lease expires. Ask your manager if they do markups on maintenance bills. For example, if they subcontract a plumber and those plumber charges are $500, over to the manager, does the manager tack on, say, 10% to that charge and then charge you $550 or not? Preferably, the answer is no. Markups like that can be another profit center for property management companies. However, what this manager does is instead they have a trip charge of $55 for when their maintenance guy visits the property, and I was okay with that. That's reasonable. Also, ask your property manager if they do regular inspections of your properties. That means that they physically go inside the unit from time to time to confirm that everything is all right, that your tenant is treating your property with respect, and that there aren't any deferred maintenance items cropping up, like delaminated flooring or some kind of water leak that needs attention. And this particular manager that I just decided to hire, they charge $75 a year for 2 of these annual inspections. So they physically go inside the unit every 6 months for a comprehensive check, which is a really good idea, and I love that they do that. Another tactic that I take when vetting a property manager is to ask them, just a detailed question or two, really feel out their operations. It can be a good idea for you to do something like this. For example, I told this new manager that, in the past with other management companies or ones I still use, I've seen managers, they try to charge me for clearing a clogged sink drain. Well, I've let managers know I should not be seeing charges like that at all. In almost every instance, clearing clogs, that should be charged to the tenant, not me. I mean, obstructions don't float up from water and septic systems. So in most cases, that is what's happening. So, the tenant is at fault for getting something clogged in there in almost every case. Now, one exception might be that, I don't know, tree roots encroach on plumbing or something like that, okay? But the point is, when you ask about something like that, you're showing your property manager that you're savvy and you can't be taken advantage of, okay? They have got to be the ones that pushes back on the tenant sometimes, not pushing on you every time, just because they feel like you're the one that can afford the expense more than the tenant. So that sets some expectations for the ongoing relationship. Also, talk to your property manager about your communication preferences over time. Now, for me personally, I don't want an intrusive text message unless it's something that's pretty urgent. I prefer email communication, and the manager does not need to email me every time they need approval of expenses less than, say, $300. And when you get more faith in your manager, later you might want to bump that number up to $500 or whatever your number is. Now, at times, I do like to call my property manager on the phone. Sometimes you'll just get more information from them this way, a better feel. When I called a different property manager that I currently have, one thing that they mentioned to me on the phone, they were like, "Oh, Keith, I've been meaning to call you. You've had a vacant unit for weeks, and we should probably lower the asking rent $50 to $100. All right, well, I agreed that we should do that, but I feel like the vacancy would have lingered longer at the higher asking rent had I not called. So really, this is the sort of light touch that you should give your properties over time, and it's the reason that why, even with professional property management, it's not completely passive. Instead, it's a little contact. And I also like to tell my property manager that I have mortgages on my properties. I have every property mortgaged and always have. You can choose to have your manager pay your mortgage for you, or you can pay it yourself. And that's a bit about vetting and managing your property manager, and I hope some of those ideas go a long way toward helping you. Really, they're the frameworks about what's important and establishing expectations with them up front. This week, a great guest and I will discuss trends in today's real estate investment market, and then we'll tell you about an event that you can join and how to specifically exploit an especially promising real estate opportunity that I have never seen before. That's next. I'm Keith Weinhold. You're listening to Get Rich Education. Hey, you can get your mortgage loans at the same place where I get mine at Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than any provider in the entire nation because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. You can start your pre-qualification and chat with President Chaley Ridge personally. Start now while it's on your mind at ridgelendinggroup.com. That's ridgelendinggroup.com. Your bank is getting rich off of you. The national average bank account pays less than 1% on your savings. If your money isn't making 4%, you're losing your hard-earned cash to inflation. Let the Liquidity Fund help you put your money to work with minimum risk. Your cash generates up to an 8% return with compound interest year in and year out instead of earning less than 1% sitting in your bank account. The minimum investment is just $25K. You keep getting paid until you decide you want your money back. Their decade-plus track record proves they've always paid their investors 100% in full and on time. And I would know because I'm an investor too. Earn 8%, hundreds of others are. Text FAMILY to 66866. Learn more about Freedom Family Investments Liquidity Fund on your journey to financial freedom through passive income. Text FAMILY to 66866.
This is Rick Sharga, Housing Market Intelligence Analyst. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
This week, we've got the privilege of hearing from a seasoned real estate investor. He himself is in single-family, multifamily, and commercial. He's also a licensed optometrist, and he practices on a volunteer basis, giving away his time and expertise there. In fact, he started investing in real estate while working as an optometrist and captain for the U.S. Air Force, and that on-the-side real estate investing allowed him to retire early from medicine, and today he's an industry expert in real estate market analytics and how to use real estate as a means to create the lifestyle that you, the listener, desire for your family. Hey, welcome to GRE, Zach Lee Master.
Keith, thanks so much for having me on again. It's good to be back, and always a pleasure to talk real estate. I learn a lot from you and the content you put out, so I'm a big fan, and I appreciate you having me on.
Well, thanks for saying that. Well, I'm sure we're going to learn from you today, too. You've got such a great take and feel for the pulse of the residential real estate market. Tell us about your take, whether that's price direction, rents, occupancy rates, supply, interest rates, demographics, whatever you think is important. Tell us about what a real estate investor really needs to know in this era, Zach.
Man, and this could probably be a whole day conversation, Keith. I think you've done an excellent job covering this every time you put out information. So we won't belabor the point, but I guess my general take is that, we're moving into a section in the market cycle, I believe, where we'll probably start to see a little bit more of a normalization of a real estate market. I mean, it's just been so strange, right, to pull data points out of the past 2 years and actually really 4 or 5 years of there's really some unique things happening. And there's a lot of people that have projections around how housing prices are changing and things like that. The only really thing I think the big takeaway from the past 2 years is that home sales have plummeted. People talk about real estate crashes, real estate prices really didn't change that so much. And actually in a lot of the markets like where we focus on, they went up because of, supply and demand. These are areas where there's a huge discrepancy and there's an undersupply of housing. And those are kind of the areas you want to be in the path of progress. But one thing that we did see over the past 2 years is that there was a plummet in home sales. And that's both with less buyers because of the interest rates and less sellers holding on to their low interest rates. People are less likely to move in those scenarios. So I think we're going to see more of that as we start to see interest rates coming down over time, and we'll probably see more inventory hit the market, but also a new influx of buyers. So I don't know if there's going to be much of a change in terms of pricing, but generally speaking, I think there's, from the investor side, a lot of what we talked about is retail, but with the investor mindset, which is your audience, I think what we will likely see is that there's probably a lot of people that were sitting on the sidelines that will jump into the market. There's going to be more buyer competition. Of course, that drives prices. And one thing we know for a fact that we'll dive in deeper today about, Keith, is that there are builders, because a lot of what we do is in the new construction build-to-rent industry, and we could talk about why that is, but that's just a solid asset class to maintain consistent income, quality tenants, growth and potential, and both home appreciation and rents. But I think what we're likely to see is that over the past year, there's been a lot of builders giving out these crazy incentives because they've had excess inventory and they've had a slowdown on the retail sales. And it's been a really unique opportunity for investors to come in, acquire good assets with these crazy incentives and below market pricing, which we'll talk about, that is likely going to disappear over time as they move more into the retail sales and those channels start to open up more because there's more buyers. And so in the niche that we work in, that's kind of the takeaway that I think is developing really over the next few months here.
Yes, this reduction in sales volume that we've had, like you touched on, which lower interest rates could help thaw. Almost everyone agrees that interest rates are going to fall more slowly than they spiked in rows in 2022. And it's funny, Zach, I can be in the front of a room talking about the condition of the economy and the real estate market. And I can say to the audience, Zach, I can say, if you think there's uncertainty right now, a substantial amount of uncertainty, raise your hand. And virtually everyone raises their hand, but you know what? They did the same thing 2 years ago, and they did the same thing 5 years ago. So my point is, investors invest through the uncertainty, because uncertainty always exists. It just shifts around as to where the uncertainty is. The listener might be trying to validate sort of one thing in their mind and get it to balance out right now, Zach. When we talk about this lowering of sales volume, and you mentioned builders that are sitting on some inventory, yet we have a lack of supply. Can you balance that out for us and tell us how that is that some builders have inventory that they're sitting on, that's supply, and yet we have an overall lack of supply?
Yeah, and I think the other key piece into that is lack of affordability, right? And so all those things kind of play together. Just to tie up your last point, there's always uncertainty in real estate, but there's also the fundamentals of real estate. Keith, you know this as a longtime investor, investing all across the country. As long as you stay focused on the fundamentals, which at the end of the day is really investing in good locations with good teams where you have positive cash flow, right? And you likely have a positive outlook from an economic standpoint for that market to keep the house rented, to keep rents going up. Like, that's really all there is to this, to be successful long term. That can exist in any market cycle. So I just encourage people to stay focused on that. But ultimately, your question about inventory supply, we talk about big things of like lack of inventory. I mean, we have a deficit of, I think the last stat I saw was 7.5 million houses, deficit or something like that. But that's really on the global economic picture for the US, right? When we break it down to the kind of the microeconomic scale with each individual regional market, because we work with regional builders as well as national builders, and we're also a builder. We also put up our own houses as well to a somewhat small scale, but a lot of those builders started the houses that are now completed, at this point, sometimes 6 months ago, more likely 12 to 18 months ago. And they had anticipation, as the Fed was talking about interest rates lowering, but they maybe were planning an X amount of sales for those exact houses. However, from the retail standpoint, there really hasn't been that movement. So we still have a lack of homes that we need, but we also have a lack of people that can buy those houses because there's a lack of affordability, right? And all these builders also have X amount of houses that they sell to institutional buyers, the BlackRocks and some of these buyers that will come in, and we'll talk about why that's relevant to us and how we've pioneered our way into operating like one of those for the individual investor and bringing those same buying incentives to the everyday investor. But there's also been a large decrease on investor activity from an institutional level of buying. So just because we have a reduction in inventory and we have a low supply does not necessarily mean that we're just going to, builders can just sell all their homes because of that. There's a lot that plays into that, and you need to look at each geographic market. But ultimately, if you're looking at the fundamentals of investing in real estate, where you can still be, and we try to be below the median house price point, below that $400,000 price point. Again, that's where we have the largest demographic, big affordability issues right now. I think that's a safe place to be, right? Because you don't see the fluctuations that you do on the more expensive homes, the more expensive markets. I think you have the large demographics for both renters and retail buyers, and you also have more runway, right? More runway for prices to go up. So that's kind of the niche area that when I'm talking about excess supply, that's the area that we're really focusing on.
Oh, that was beautifully explained in how to tie that supply story together there, Zach. Of course, there are so many ways to divide up the real estate market, one of those being that price tier. And typically for us as cash flow real estate investors, we look at a single family home. Yeah, it's going to be under $400K in order to generate income. I have an announcement to make here to you, the listener. On Thursday, October 24th, one of our GRE investment coaches, along with Zach here, are co-hosting GRE's live event for new build turnkey income properties with zero money down. Yes, I'm stealing some of your thunder there, Zach. Zero money down. Registration is now open at grewebinars.com, and the momentum has been building for this event that you can attend from the comfort of your own home. Tell us about what you'll be covering at our live event, Zach.
Yeah, and I'm very excited to do that, Keith. I appreciate you having me on again. I think all the investors, if you're interested in new construction or just creative finance and some ways to make some unique deals happen, like, you have to attend this webinar just to at least learn. First, we'll talk about different markets right now where we see the best opportunities. So if nothing else, you'll learn about some of the best markets to invest in. But really what we're going to unveil is how someone, regardless of where you live geographically or your investing experience, how you can make a creative deal happen on a turnkey deal that you can get below market value and possibly buy with zero money down or at least have a good portion of your down payment covered to really skyrocket your ROI. So this is a scenario, Keith, where you really get to have your cake and eat it too, because you get a brand new constructed house that's turnkey, where everything is done for you in a great market that has appreciation both in rents and prices, but you can also buy it with low to no money down and really be a creative investor. And I know that we're going to talk about all the details with that.
Yes, let's talk more about the potential for zero money down here. I mean, I think that's the most compelling value proposition with what we're doing next Thursday.
Sure. So we'll just go through a numeric example so people can kind of wrap their head around like what this entails. We already set the stage for, why builders may have excess inventory. And what we do with our business is we partner with both regional and national builders, some of the, largest national builders, as well as I mentioned, we build our own homes as well. But we partner with some of these national builders that have excess inventory in markets that we know are productive investment opportunities. A lot of these happen to be in the Southeast because that's where the population is growing, and we're seeing that's where favorable landlord legislation is, and favorable taxes and growth potential, all the things, right? Positive cash flow. But we focus on those areas, and we can go to these national builders because as a group, we buy hundreds of houses every single year, and we can basically approach them like an institutional buyer and say, we want the same access to those wholesale deals that you would sell to BlackRock, but we want that for ourselves, and we can pass that on to the individual investor. That's kind of the value add. But specifically what we're talking about is a scenario where some of these builders will offer up to a 10% credit at closing. That is huge. And for someone that is just new to the real estate game, is kind of learning about this and I've been investing personally for 15 years now. I've never seen things like this in any market cycle. That's through multiple different market cycles, but I've never seen anything this attractive. So this is not normal. I want to say that's to start. But essentially, you can get up to 10% of a credit on a house that you can use however you want to. And so there's a few different ways that you can use this, Keith. So if you're buying a $300,000 turnkey new construction home, you could, in theory, get $30,000 off and buy that at $270,000. You have $30,000 of immediate equity. That might be a good strategy if you're looking to lower the mortgage payment on that, or if you're looking to, say, refinance that property or sell it quicker. You have that immediate equity in that house, right? The other thing you could do with that 10% is you could use it to buy your interest rate down. And that will get you below 4%. You can literally buy your rates down into 3% with that much. If you want to put that much money into it, it'll cover your closing costs and buy the rate down significantly. So no matter what the Fed lowers the rate to, you are back actually down to 2021 rates by buying your way there with that huge credit that obviously causes, cash flow to skyrocket and your ROI to go way up. The third option that you can do is you can actually take that money and just get it back as a credit at closing. So if you're buying a house, say a $300,000 house, you're putting 20% down, which would be $60,000 on that house. You could get $30,000 immediately back. That means you're into the house for 10% or, half your down payment. That also skyrockets your ROI. So the point is there's a lot of creative things that you can do with these type of exciting credits. And they vary between 5 to 10% based on inventory, but they go up to 10% on some of these new construction inventory options. One last thing here, Keith, and this is, hopefully I haven't lost anyone, but this is where things get really creative. As a company, we also work with different lenders throughout the country to bring the best financing options to investors. And we have a group of credit unions, they're all local to that geographic area, that have portfolio loans, meaning these are not Fannie Mae, Freddie Mac loans. These are loans they hold in-house. These are true investor loans. You still have to qualify for them. But if you qualify, you can put as little as 5% down, meaning they will finance up to 95% of your property. We have tons of investors doing this consistently. And you can do this on up to 5 investment properties if you qualify. And so that means in theory, you could buy a brand new construction house with a 5% down loan. You get a 10% credit back at closing that covers your down payment, your closing costs, and likely puts money back in your pocket. So that's not only buying a new construction turnkey house with no money down, it's actually getting paid to do so.
Gosh.
Now, there's a lot of economics to understand and cash flow, with a high leverage and things like that, but that's a concept and it's very exciting.
Yes, that last option that you mentioned seems to be the most compelling. I know you've got investors that are learning about this and have already taken advantage of that. And again, that last option is getting the 10% credit that you're getting from the builder, coupling that with a 5% down portfolio loan from a local lender, which effectively would give you 5% cash back at the closing table. However, your closing costs and prepaids might be something like 4%. So really, in the best case scenario, not only are you zero money down, you're getting about 1% of the purchase price, or $3,000 in this example, back at the closing table. Now, of course, that's going to affect your cash flow, but you got to think about what's important to you. So when one thinks about what's important to them as an investor with some of those options that you laid out there, Zach, I really highlighted the last one. What are some of the trade-offs, the pros and cons of choosing these different incentives that the builders are giving right now?
I'm so glad you asked this, Keith, because someone could be very excited about the idea of no money down, but that may not actually be the most strategic benefit to them. The nice thing is that there's so much incentive to buy right now with these type of, kickbacks, these incentives that like you can structure a deal that's specific to you and your goals. But I would really encourage the audience to understand, what is your exit strategy, or what is the next 3 to 5 years? Why are you buying this property, and how to strategically apply that? And if you don't know, if you need some guidance through that, let us help you kind of understand the different scenarios. But I want to work backwards first and mention one more thing. The no money down option would be really attractive because cash flow is going to be limited in that scenario. You still have a loan that's covering 95% of the house, right? You would expect it. And you don't have to only put 5% down, right? You can put 6, 7% down. So it's, maybe break even cash flow. It's up to you. But the investors that really like that option, including myself, is the people that want to grow and scale their portfolio and stretch their capital the furthest. They maybe don't care so much about cash flow right now at this moment. They know that cash flow will increase over time. But if you're someone who really takes advantage of the tax benefits of real estate, this is a way to, honestly, without any money out of your pocket, just taking some action, you can create this huge tax benefit, right? Because if you're buying 5 properties with virtually no money down, and let's say those are each $200,000 properties, you could essentially buy $1 million worth of real estate that you own and control 100% of, and you get the huge immense tax benefit. So if you're doing things like cost segregation studies like we do, you can create hundreds of thousands of dollars of tax deductions without any money out of your pocket, just being strategic this way. But let's talk about some of these other options, because that was a real question. Where would it make sense for people? So again, if you say that 10% on a $300,000 house, that's $30K. If you wanted to take that as a price reduction right out of the gates, that would obviously lower your mortgage. That's going to lower the mortgage payment amount to allow you to cash flow more. But I think the strategy or the play there is that you have built-in equity in a house. This means that if your plan is to maybe put a HELOC on the house, do a cash out refinance in a few short years, as that house continues to appreciate, again, because it's in a growth market, you're just going to cut that time in half because you have built-in equity. Or if you plan to sell it, there are some scenarios where you could turn around and almost flip this. In theory, you could do it if you really run the economics. It wouldn't be hugely profitable, but in theory, it could be profitable if you sold the house with, even immediately, because these builders are still selling these houses at retail, setting comps at the full market value. So if you have 10% and you're paying a realtor 5% commission, there's still closing costs, but you could, net some capital. But better scenario is probably if you're holding it for 2 or 3 years, again, letting it continue to depreciate. Your option is to sell it. Then you're into capital gains, or you can 1031 exchange it. That might be a good option to have built-in equity. Or if this is going to be a long-term hold for you and you're just like, I love this area where I'm investing, I want to maximize cash flow, I want to have a long-term loan that has a really low interest rate, then actually applying the majority of that capital to buy your rate down, that's going to obviously maximize cash flow. And that's also going to lock you in on a 30-year fixed loan at a really low rate. Maybe you want to buy the rate down. So that's really the two options. We see most investors either taking the capital back and using the zero money down option, or buying the rate down, because that's going to allow them to really cash flow well. And they're just going to hold that property for a long period of time and let real estate do what it does. Those are kind of the different scenarios I think that make sense for different investors in understanding where to apply this incentive.
Sure, if you go for a high loan-to-value loan at 95% or even 100%, you really then pursue the infinite return strategy, have maximum leverage or complete leverage in the property, have all the inflation profiting benefits magnified because you're borrowing more, but that scenario is going to reduce your cash flow. So it's all about what's important to you as a real estate investor. Well, Zach, before you go, just tell us a little bit more. I think the listener is going to learn more on next Thursday's webinar, but just give us a bit more on property types, whatever else one might want to know.
Certainly. So this is mainly in the Southeast. Okay. So these would be markets like Texas, Alabama, Carolinas, Florida. We have some stuff in Tennessee, but I mean, this is really the growth markets, right? Where we have landlord-friendly legislation, low taxes, we have affordability, but we have huge population trends moving to these areas. Those are the areas we want to be. Those are the areas where builders are building in because supply and demand. Those are areas where we're positioned for strong growth over time. Overall, our average rental increase is 6% year per year, and that's going back on data over the past decade, Keith.
It's really good.
So then, yeah, usually double the national average there. So those are because we're specifically positioning ourselves in areas where there's increase in rental demand and population and economic growth. Average home prices, I mean, we have new construction homes as low as $200,000. By the way, side caveat, we also have some rehab homes that are in that $130,000, $150,000 range that you can still use a low money down. Those don't have as high of incentives as the new construction do, but average price for new construction, $200,000 to $300,000, give or take. I mean, just buying them, if you're buying them with a conventional loan with 20% down, you're still looking at 8 to 12% cash on cash returns. Let's just talk about the cash flow. So they're really good properties that cash flow well, which is hard to find today, and they're in good locations. I think that's really the main point I want to drive home as we finish up here is these are single family residencies in good locations, you guys. I've invested, as you mentioned in the nice intro you gave me, I mean, real estate allowed my wife and I to retire from our career paths as optometrists through investing. That did not happen overnight, but it did happen over a period of time. And it didn't take a lifetime either, though. That's the thing I want to mention. Over a short few years of intentional, dedicated investing, we learned that really focusing on growth markets and new construction houses allow for the best quality tenants, the most predictable returns, and the best growth in rents and appreciation of the houses over time to build equity. Those are the kind of assets that we want to hold long-term and will help you build wealth in a short period of time. So that's kind of been the direction of our business model, is focusing on quality inventory in good locations with good teams that still have good cash flow. But you mix in some of these incentives, Keith, and it's just like, it's a no-brainer. And I do think this is, the biggest thing is a sense of urgency here. This is unlimited inventory. This is not something that's normal, as I mentioned. And this buying opportunity that we're so excited about is not going to last forever. As we started this conversation talking about the market shifting, as interest rates continue to come down over time, that will continue to bring more buyers into the market and just less motivation from builders to offer these incentives. So guys, now is the time to take action and make really good investments now that will set you up for success for many years.
The time is now. This is one of the best deals I've really learned about here in the recent past at all. This could be of any benefit to it all. You really want to jump in on this because, like Zach said, this won't last forever. Well, Zach, before I ask you for your closing thoughts, again, for you, the listener, be sure to sign up for GRE's live event. This is for new build turnkey income properties, potentially with zero money down. It is Thursday, October 24th at 8 p.m. Eastern. Register at grewebinars.com. Any last thoughts, Zach?
Keith, I just appreciate all the information you're putting out there. We are all thrilled about real estate as an asset class. It's been an interesting past few years, but again, just going back to the fundamentals, guys, invest in good properties and good locations with good teams. And I promise you, if you do that consistently over time, you will reach financial independence or whatever financial goals you are striving to achieve. There's more millionaires remain in real estate than any other asset class, and it's the most predictable path to wealth. There's no secret about that. But it does take consistency in any market cycle. So Keith, thanks so much again for having me on.
Oh, those are great parting words. And you, the listener, are going to get to talk more with Zach and one of our investment coaches next Thursday. It is live. At the end, you will have a chance to have your questions answered in real time in case you want to talk to Zach more. Hey, it's been great having you here. There's something in the market cycle there that we can really take advantage of. Builders have some excess inventory, and see, the money that they have tied up in them is something that they're paying a fairly high interest rate on too. And we have now partnered with some of the biggest builders: Lennar, D.R. Horton, and others to get you this institutional grade buying power, buying at scale for lower prices and better incentives. Like Zach and I said, new builds in the southeastern U.S. for purchase prices of $200 to $300K, offering you up to a 10% credit at closing. So on a $300K rental, single-family home, you can then use as much as $30K and choose what you want to do with that. You could buy your interest rate down to 3%. That's probably better if you're going to hold it long term. Or use on your closing costs and have some to use toward your interest rate. Or alternatively, you could just take it as a price reduction. A $300K property is now $270K. Maybe you can even enjoy the discount and sell it in the next, say, 2 to 3 years for a profit. You're likely not going to be immensely profitable that way, but you don't know what the market will do over time. All right, so it'll typically be a 5 to 10% credit, and that depends on the property that you seek here. All right, so that is the builder credit bucket there. And then in addition to that, if you qualify, you have some good, say, credit and assets, well, you can get a financing option through local credit unions, and that is local to the area that your property is in, that will extend you a portfolio loan if you qualify. You'll learn about how to do this, and this means you can put as little as 5% down, and you can do that on up to 5 investment properties. Okay, so with those buckets or those two incentives combined, you could then get a 5% down loan with a 10% builder credit, so that 5% back could cover your closing costs and even just put a little money in your pocket. You should sort of think of all of that as a best case scenario. You might be pretty excited about no money down, and you probably should, but attend the event and weigh the pros and cons and see if that is the right avenue for you. A lot of it comes down to, what do you want to optimize, your cash flow or your leveraged equity? This is an action-taking time for you to get a good chance at being set up for financial success for years. I mean, it is opportunities just like this. I mean, you learn about these concepts on the benefits of real estate investing here on the show, and now here's something really tangible where you can get ahead. I mean, personally, for me as an investor, I've never had an opportunity like what we're talking about here before. If you so desire, you can own new build property and learn how to get it tied up at the event. Make sure to sign up and put it on your calendar. That is next Thursday, the 24th, from the comfort of your own home. GRE's live online event for new build properties in growth markets, potentially with zero money down. It is free to register, and as of now, there are spots available at grewebinars.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.